Okay, now this is the second video for chapter 13 for investments. We're going to talk about price earnings ratios a little bit more. We're going to talk about free cash flows and a few other models that we use to measure stocks and potential and things like that. So price to earnings ratios and growth opportunities. So the price to earnings multiple is the ratio of stock price to the earnings per share, which is the determinant of the PE ratio. So remember here that P0 is my price, that you purchase price usually, because it's P0 when you buy it in the first place. E is the expected value, 1 over K. K is my market capitalization, and PVGO is the present value of my growth opportunities. The PE ratio for a growing firm growing at long run sustainable pace is again price over expected future value. 1 minus B. B is my reinvested earnings. So that's one of the reasons why this is talking about a long run sustainable pace, because a lot of times we reinvest earnings when we're a growing firm. Over market cap minus return on equity times the earnings. So the PEG ratio is a ratio of the price to earnings multiple to, or the earnings growth rate. So this table 13.3, we use the equation that we just looked at to compute both the growth rates and the PE ratios for different combinations of return on equity and B. While growth always increases the plowback ratio, if you move across the rows in panel A, the PE ratio does not move across the rows in panel B. And the top ratio of this table, panel B, and the PE ratio falls as the plowback rate increases. And the middle row is unaffected by the plowback rate. So you can see here, whereas the last one is increased by the plowback rate. And plowback ratio, we're talking about money that is kept and reinvested in the business. So, you know, when a company earns money, they really have 2 options of what to do with it. 2 options are paid out as dividends or to put it back in the company for growth. So you'll usually see companies that are in a growth industry or in a growth time of their stage, their life cycle, will typically use more of their earnings for internal reinvestment versus dividends, whereas you'll see usually companies in the later stages of life cycle pay more dividends and would have a lower plowback ratio. All right, PE ratios and stock. We're going P over E, so price over earnings equals 1 minus B, B being my plowback ratio, over K, my equity, minus G. So all else equal, riskier stocks have lower PE multiples and higher ROI and K. That's a required rate of return, by the way. Okay. So this is the PE ratio versus the S&P 500 versus inflation rate. So we get the annual averages here from 1955 through 2016. So this shows that the PE ratios generally have been inversely related to the inflation rate. In part, this reflects the market's assessment that earnings in high inflation periods are of lower quality, artificially distorted by inflation, warranting lower PE ratios. So you can see that we can look at the inflation rate and that it's inversely related to the PE ratios with this chart. The pitfalls of PE analysis. So it's not perfect. PE is a good analysis to use and one that is often one of the top ones used by investment firms. But there are limits to it. Earnings management is one of them. The practice of using flexibility in accounting rules to improve apparent profitability of a firm. Accountants have options on how they record things. There's also things like estimates within our accounting policies. So we can, or they can, although they're not typically supposed to, manage their earnings by adjusting things, estimating things differently, and there's certain other discretionary elements that the accounting companies or that the accountants for the firms can utilize to make their earnings look better. And that's what earnings management is. This is actually what I'm probably going to write my dissertation in. This is in the earnings management area. Okay, this chart shows the earnings per share for Con Ed and PepsiCo, Consolidated Edison and PepsiCo. And this plots their, this graphs their earnings per share. And the next one for the same two companies, this is the EPS. And this one plots their PE ratios. When earnings depart from the trend line, the PE ratios do also move in the opposite direction. For example, when Con Ed's earnings fell from 2001 to 2003, the PE ratio rose. Similarly, when Pepsi's earnings per share increased at an above rate trend of 17% between 2008 and 2009, the PE ratio fell. So you can see the fall here for PepsiCo, and then Con Ed, we have 2001, 2003. Okay, this part right here. And you can see what happened with Con Ed 2001, 2003 versus PepsiCo in 2007, 2009. You can see it falling, the earnings per share falling. All right, combining the PE analysis and the discount models, it estimates the stock price and the horizon date. Other comparative valuation ratios, price to book ratio, so the ratio per share divided by the book value per share. And this is oftentimes a useful measure because it's a fundamental value, and therefore treat this ratio of price to book as an indicator of how aggressively the market values the firm. The price to cash flow ratio, cash flow is less affected by accounting decisions than earnings. A lot of people using cash flows as a more secure, kind of a less risky method of judging earnings, because the fact that cash flows can't really be affected by earnings management. They can't really be affected by choices in accounting. Price to sales, this is mainly for companies that are in the early stages where they haven't had either no earnings or very little earnings to begin with. So you can look at this for someone like Tesla, who's pretty new. And if you look at how much money they're actually earning, it's not very much, but the price to sales is a ratio they use to benchmark firms that there isn't really much, a very easy way to value them. All right, this shows 13.6 here shows evaluation measures for the S&P 500. While the levels of ratios differ considerably, for the most part, they track each other fairly closely. The PE ratios, the price to sales ratio, and the price to cash flows ratios are the three that we're marking on here. Okay, free cash flow for another valuation approach. Free cash flow for firms. Free cash flow, the EBIT, that stands for earnings before interest and taxes, and then times 1 minus the corporate tax rate. So effectively, we're showing how much is going to be left over after taxes there, plus depreciation, because depreciation is an expense, so it would be on the financial statement as an expense, but it is a non-cash expense, so we add that back in. Minus any other capital expenditures, because those would also be capital expenditures, would not be expense because they're expense or depreciation instead, minus any increase in our net working capital. Free cash flow to equity holders is the free cash flow, that one we just figured out, the free cash flow for firm, minus any interest expense times, again, 1 minus the corporate tax rate plus the increase in net debt. Estimating terminal value using constant growth model. So the firm value here is the sum of my 1 plus my free cash flow divided by my 1 plus the weighted average cost of capital plus plus my PT, and my PT is my free cash flow for time frame plus 1, so next year, over my weighted average cost of capital minus G. So this gives me my firm value and estimates my terminal value using a constant growth model. All right, so an example, suppose that we had free cash flow for firm of $1 million for 4 years, years 1 through 4. And then it's expected a growth rate of 3%. Assume the weighted average cost of capital is 15%. So this would be my firm value, 7.76 million, and then all they're doing is plugging this into the formula that we just looked at. If 500,000 shares are outstanding, what is the predicted price of stock if the firm has $5 million of debt? And the answer is we should take the firm price minus the debt, because that's the actual amount of equity, right? The value minus debt should be the equity value, divided by the number of shares. So $5.53 per share would be the answer to this. Okay, market value of equity. Market value of equity. Again, we got our free cash flow and equity over 1 plus K for earnings. And then my PT again, my free cash flow here, T plus 1, KE minus G. There's a market value of my equity. So again, so for free cash flow for equity rather than free cash flow for firm, if we had $900,000 for years 1 through 4, and then expected to grow at a rate of 3%, assume that the KE is 18%. That gives me a $2.5 million market value of equity. If there are 500,000 shares outstanding, what is the predicted price of the stock, and why can debt be ignored? Why can debt be ignored in this? Let's go back and look at the ratio. Because if we have our free cash flow here, we can have, the only change would be an increase in net debt. So only if there was a change in debt would we care about that. Okay, this is a spreadsheet in your book on page 417, and this shows a free cash flow valuation of Chevron. We start with free cash flows from firm approaching the given equation 13.9, and this spreadsheet lays out the values. This calculates the free cash flow, the sum of after-tax profits. You can see after-tax profits, interest, change in working capital, depreciation, to get us our free cash flow for different years, and our free cash flow for equity for the different years from 2018, and then the assumed for 2020 all the way up through 2021. So comparing these valuation models differ in practice. The differences stem from simplifying some of the assumptions. So some things that we assume, and also some of these are estimates. When we talk about growth and potential growth, a lot of times we'll run this through with multiple areas of potential growth, because that obviously changes my function quite a bit. Problems with the discounted cash flow models. Discounted cash flow estimates are always somewhat imprecise. Investors employ a hierarchy evaluation of real estate, plant and equipment, economic profit on assets in place, and then growth opportunities. Forecasting the aggregate stock market. Earnings multiplier applied to the aggregate level. We can forecast corporate profits for a period based on the aggregate level of the multiplier. We can derive an estimate of the PE ratio based on long-term interest rates. And some analysts use this aggregate discounted model. So this is the this is 13.7, where so the PE ratio of the market is sometimes derived from a graph similar to what we see here. This plots the earnings yield, which is the earnings per share divided by the price per share, the reciprocal of the PE ratio, and the S&P 500 and the yield to maturity of treasury bonds. These two series clearly move in tandem over time and suggest that one might use the relationship in the current year on 10-year treasury bond to forecast the earning years of the S&P earnings yield, on the S&P 500. Given that the earnings yield, a forecast of earnings could be used to predict the level of the S&P in the future, we can utilize this, potentially utilize this, and you see how the motion goes pretty much in the same direction. So S&P 500 index forecast under different scenarios. And that is it for chapter 13.